Give everyone a minute or so. Two handsome blokes. Well, we'll probably start in about 30 seconds on people. Welcome if you're already here. All righty, Kai, shall we start?
I think so.
Cool. Okay, everyone, welcome to either if you're on demand or watching live. Yeah, so we are, we're going to give you a bit of a, bit of an education piece in terms of how to invest at record highs or all-time highs. We're obviously it's not necessarily happening in the ASX market at the moment, but it is in the US. So we'll sort of go through. So to give you a little bit of background, Kai and myself, well, I was a professional trader started in the 90s, from mid 2000s on. Kai was actually one of the traders at my firm, and if not the best trader in our firm. So, but over that course of time, trading in fairly high stress or day trading in those high stress scenarios in derivatives with a lot of leverage and things like that. And then your career onwards from that was high frequency trading, which you can explain later. Basically, we got, for what investors go through, you might need to make 100 of those decisions in your life. We kind of had to make 100 of those decisions a day.
On a daily basis.
Yeah. So this is sort of from our experience, based on that repetition. So I think I worked out I was at about 100,000 hours that I'd done trading by the time I'd finished. And so we're just going to give you some tactics, and then we're also just going to run you through how we're solving the problem for our clients as well. Some parts of it may not be relevant to you. Some parts of it may be very relevant to you. We're not telling you that, what you're doing is right or wrong, well, whatever. This is more of an educational thing in terms of trying to cater to as many people as we can in terms of if you want to keep managing an entire equities portfolio, what's changed and how to do that, etc. And then a bit of a story about how we, over the last 3 years since we founded MPC, how we sort of changed and adapted our philosophy to the current market conditions. So yeah, well, we just go to the next one. General advice warning. The content presented in this webinar is for informational purposes only. It is general advice only. It does not take into account your personal circumstances. Please, consult a financial professional before making any financial decisions. If you want any more details, our financial services guide is available on our website. Past performance is not an indicator of future performance, but when we do use a little bit of stats, and there are product examples in this that involve 100%, 100% of capital at risk as well. So, just a run sheet today. We're just going to go through how markets have changed. Then we're going to go through how we've adapted. We're going to talk more so just stock markets, and then we're going to go and have a look at how we've adapted our execution policy for our clients and why we did it. And then, the back half of it, was where we'll probably get to that story where, over time, we've consulted our clients, we've asked them what they wanted, basically better returns, lower risk and less stress, don't we all? And then we'll go through how we've sort of modernised our portfolio construction using just, not just traditional stocks, but a combination of traditional stocks with structured investments, traditional stocks, and new ways of getting the same thing, I suppose. So Kai, what's changed in 2026? You're probably the better person to ask about this. So just give a bit of background on your HFT and algorithmic trading.
Sure. So I've been in trading game for about 15 years or so. Obviously starting off as a prop trader, and then I moved to the algo firms. And it's really interesting because, like it's very different to what it was 20 years ago. Because 20 years ago, it was driven by a lot more emotion, a lot more people in front of the or in the markets or in front of the screens. Fundamentals, right? But at the moment, a lot of the market is controlled by algorithmic flow. So what they have is they have these signals that they create, and it will blindly follow, right? So what it's creating,
and it's more around risk than it is almost fundamentals.
However the strategy they create, it just follows that rule until it reaches a barrier that they say we're not willing to go anymore. But the issue is a lot of these firms are doing the same thing. So what happens is you get this massive feedback loop, and this is what we're seeing in a lot of stocks, right? So we're either seeing companies drop dramatically and there's no volume that's buying, and we'll go through a couple of these stocks.
Well, that's more, particularly the ASX, because we've seen the flows into ETFs, like beta shares announces record, and so does Vanguard every year. But what that's doing is eliminating mid-cap fund managers who would normally provide that liquidity. So we're seeing those really severe drops.
Correct. And some of these moves are extremely severe, and on the upside as well, you get to see things, stocks that are in theme at the moment or have a fundamental reason why they go up. But again, it's not based on valuation anymore. And I think that's the key thing.
Yeah, I mean, we've obviously got, the likes of Palantir, Nvidia, those sorts of things, and Micron in the States. Like Drone Shield here was a $9 billion market cap at one stage, Life 360, things like that, where once it goes, it goes until it hits a real order.
I think even Warren Buffett was admitting that this has become an extremely speculative market.
Or gamified, I think it might have been the term potentially used. But look, momentum now outstretches valuations on a regular basis is, I guess, the main point on the positive side. So if you're long and you've got a company that you want to own, it will, quite often, if it gets on a run, it will go further than it ever would before. Conversely, you miss, and we've seen a lot of this in the ASX particularly, there's a vacuum, and recently Cochlear, CSL, things like that, like proper blue ribbon companies, or even BHP a year and a half ago. I mean, that we really, BHP has been under pressure until we had that turnaround in the resources sector, and now, it's going the other way. And that sort of sucked a little bit of the air out of CBA, So, I mean, which was on one of those momentum runs. So, I mean, that bearing in mind, valuations and fundamentals do still matter. They just matter differently.
I think it's more speed and the way that you have to approach the market. And I think this is kind of where we shine as, ex-traders who've been in the market and who has to react. You have to be adaptive. Risk management is key, and also how you think about the market is different, right? So
so look, I mean, as we've got a good example here. So at the moment, Schiller KP, so the KP is a cyclically adjusted price to earnings ratio. So it's averaged over 10 years. So that's nearly double. I think that's the highest point since the 01 tech crash. Bearing in mind, markets go from undervalued to overvalued much quicker these days, but there's a number of these things that are saying sort of overvalued. But when you get these four in particular, all at overvalued, there's normally a 10% correction within 12 months. In 70% of cases, and then particularly this year, we did the stats. Midterm years, every 4 years is a midterm election year. In November, in the US, there is for the last 86 years, we've had a minimum 10% drop between May and October, average of 16% or 17% drop. So, we use those stats as a bit of a backbone overall to get a feel where it's overvalued and undervalued, etc. That can, I guess that in a way that very much sets our aggression levels, I guess. But we've got some extreme move examples here. So the top two are Cochlear and CSL.
Yes.
Unfortunately, I mean, look, these things happen in the US as well, but just sort of trying to give an applicable ASX example. This move here on Cochlear was 40% gap open.
Absolutely. I mean, like in terms of the earning release, they came out from a fundamental perspective. They had weak earnings, and basically they're not selling as many products in the developed markets as they were before. But if you're talking about from a valuation standpoint, does it really justify a 40% fall?
Well, yeah, exactly. So, and look, part of this thing, one thing we learned trading as well is the market is as it is. It's not out to get you. It doesn't know where you got in. It doesn't know where where you want to get out. As one older trader said to me, wise old trader said to me, it's an inanimate object. It doesn't know who you are. So at the end of the day, you've just got to. You can't expect the world to bend to your techniques. You've got to adapt your techniques to what the broader market's doing, and whether it's right or wrong is irrelevant. The name of this game is returns and risk management. But what we've seen, like particularly with CSL, it's in a obviously a downgrade cycle at the minute. But I mean, we're looking at levels now like it's 1.8 times its assets.
It's nuts.
It's nuts how cheap it is, but it keeps going. Yeah. So, and then conversely, when CBA was at highs, we would go on Ausbiz and be asked every second segment, is CBA going to 200?
Most expensive bank in the world. How many times?
How many times we had to say it, but it was up there. And I guess things will normalise over a period of time. But like you've got the examples here of Palantir and Micron. So Micron's in the memory chip, which this is a recent rally and one of our current holdings. Humble brag there. And Palantir was one that we got on as well, but they were very much about forward earnings because they were trailing PEs. They were but the momentum in this was and is it from the case of Micro, it was incredible.
There's there is a fundamental issue with memory chips, especially RAM, right? So there's a reason why this is going up. But then if you look at an approach from a fundamental standpoint, you're going, how does it justify? Like even if you looked at really far, it's just crazy in terms of what's priced in.
Well, I mean, Palantir's revenue grew to actually match it, for instance, and this happened in the case of Nvidia as well. But the horse is bolted by the time you wait for the earnings. So it's one of those things where, that sort of team invest style value trader thing. I think there's a lot of merit in it, etc. But you're also missing out on. We've worked out probably 97% of the top 20 performers in the ASX 200 in the last 10 years. You might have caught like 3 or 4. So, which is fine if you want to be that patient, but there's also a cost to not deploying your cash and things like that. So, you've got to be a little bit predictive. And then obviously technicals and momentum and charting very much helps you out, there. But even in terms of when our global alpha came to us with Palantir, the first recommendation, I looked at them and said, "You're nuts." And I did a deeper dive. It was the most expensive company in the world at that point, and then we made very good money on that trade. Yeah. So Micron as well. If you're using trailing PE, there's no way you would have ever bought it. Yeah. So conversely, so they're both of the ones at the bottom have probably done the exact opposite to what CSL and Cochlear have done. Just at other ends of the range.
Yeah, and I think the key factor is that recognizing that there's a larger portion that is speculative flow that's coming in as opposed to fundamental flow, right? Yeah. So, and going back to the point, it's like as investors and traders, you need to adapt to the market, and this is the market that we're in.
And conversely, if you're a decade-long buy and hold style investor, these top two will likely be two of the better opportunities for the next 10 years potentially. Hopefully CSL gets his act together, but I mean, Cochlear is still got a broad monopoly almost. And people are going to want to hear, although in the Trump era, maybe we were discussing the other day that maybe people are, they're switching them off, so they don't have to listen to him. But and memory chips have been a boom and bust industry for 40 years. So this will end at some stage.
It will.
So in this case, what we tend to do, we split it up into 4 different clips from our execution point of view. So we will buy on fundamentals. So we buy those first 2 clips. One when you think it's cheap, and then given what happens with momentum, inevitably another quarter when it either gets a little bit cheaper or it stabilizes. And then we split the next half of, that dollar cost average into when the technicals stabilize, and there's some stuff on Mosaic and our website around what indicators we use, and then obviously as it actually comes out. So essentially you're not making a binary decision, because if you're making a binary decision, it tends to be a bit, you're either right or wrong. Whereas we're not trying to be right or wrong, we're trying to make money.
Well, as the old classic market saying goes, Harry Hindsight's the best trader. When you look on a chart, it's so obvious that you could have bought the bot. It never is. In the moment. And that's the point, right? Like, when things get cheap and you want to position in a way where you can actually carry some risk. Right?
Yeah.
So if you deployed all your capital in one go, it's very tricky, because you'll be under pressure. If it goes 20% against you, you'll be in.
Yeah, you're in trouble. And like Liberation Day last year, that capitulation, this is probably a lesson within itself. We planned ahead and picked our entry in the ASX 200, and we bought the gear ETF, the 2.5 times leverage. And the morning of, I remember JT, I said, well, it's at our level, 7,200 or whatever it was. We're buying. And JT looked at me like, what? And I'm like, yep. And inside I was feeling nauseous. But I knew from my experience that pre-planning for those levels, we made, even 30 years into being around professional traders most of my career, I was scared that day. But you learn to stick to the plan, as uncomfortable as it is, and that ended up being the low, basically, of that move. It didn't feel like it, and I was feeling very green around the gills. But and conversely, these things as well, different set of technical rules, but you don't have to go all in one go. You can be a bit more aggressive when you're going with momentum. You might do half first. It's not really fundamental based. I mean, it is in a way, but you would prefer to be happy to be stuck with the stock. So if you want to like it long term, and then instead of pacing it out in 4, when we're going with momentum, we generally go, or at least half. Because it's always going to feel uncomfortable because it'll be overvalued. But what's not changed, we still want quality assets at good prices.
Absolutely. But there's still a place for fundamentals, right? There's a reason why things go up, like taking, Micron, SanDisk as an example, or AI. There's a fundamental reason why that's going up. It's just that you have to kind of close your eyes a little bit in terms of valuation and just go, look, this thing it has momentum behind it. And we're trading on technicals. But it's still looking for good assets. Good assets.
I mean, and one thing I don't like, there's a lot of people out there, you can only use charts, Cam. You can only use fundamentals, Cam. I think they're both so wrong. You should be using both in conjunction with each other. A builder just doesn't use just a hammer. They've got multiple tools in there. And I think this sort of tribalism around, you shouldn't use fundamentals or you shouldn't use technicals or blah, blah, blah is just stupid. I mean, why wouldn't you use all of the best tools available to you, essentially? And look, when, with those momentum things, there's things like trailing stop losses. And for those of you who don't know, so if you're on a momentum trade, you basically, as it rallies, you're bringing up your exit with it. So you can trail by 10 or 15% sort of thing is usually the way, depending on the volatility in the stock. That's a technique you can use. Doesn't really work on those gap opens, really hurt you on those stop losses and things. But what we did sort of realize was we're, adapting it, it improved the risk reward for the clients as well. And there's a lot of even the best stock pickers in the world, you still need risk management.
Absolutely.
Because at some stage you're going to be wrong. Everyone gets it wrong. There is no way, there is no investor or trader out there except for maybe Barron Trump right now. But
he does have a crystal ball.
Well, his father. But no one's got a 100% strike rate. But if you can flip a coin with good risk management, don't risk any more than $1 to make $2. If you play out the maths, it works out. So and that's what a lot of those HFT strategies were
Oh,
about.
absolutely. Like you can look at
Their win rates were only like,
if you have a 55% win rate and your the returns you're making is bigger than the losses, it's a winning strategy, right? It's about sizing and then you can scale it up. Like you don't need a ridiculous win rate. You don't need to get everything right. It's about getting more right than wrong and winning larger than losing smaller.
Yeah. And I mean, and I don't think risk management's talked about anywhere near enough. And we had examples of a client who came in with Pro Medicus, for instance. We wrote them a risk management report because it was by far their largest position. And we set out a plan of criteria when and where they should exit and what conditions, and we stuck to the plan. And instead of, most brokers would be turning around doing portfolio reviews going, it's half your portfolio, you must get out of it. We ended up selling somewhere above $200 to $300 instead of $90 on their largest position. So it's not, there's some old methodologies, and since I left trading to come to advising, there's some common truths that are just not true, basically. And it's been like human habit, basically. It's like, well, this is what we've always done, so we should always do it this way. And I'm baffled at how many of these common truths are out there. And I guess if it gets repeated enough, we sort of tend to believe it. But yeah, so obviously this was the buy and the dip in four tranches. There's a full article as well, which we'll send out as a PDF to the webinar attendees, etc., as part of the email. And there's a little bit more in depth to this. And look, we do have a modernised portfolio construction, which we're going to get into a little bit later. But we essentially went out and asked the clients, because we had a period where you're running model portfolios and then a Cochlear happens, then a CSL happens, then you're looking for yield, and then you're getting belted on Woodside, you're getting hit on AGL, and trying to construct everything in equities just didn't work anymore.
Well, it's a lot riskier, right? Because basically you're getting these extreme moves on a lot more of these stocks. So what's happening is, you can have a large position like CSL or a Cochlear in your portfolio, and it really skews that out, right? Because so then basically your portfolio becomes a lot more volatile. But the whole idea behind the modern portfolio theory actually came from the old 60-40. So Harry Markowitz back in the days, it was designed to be an all-weather portfolio where you have unrelated assets that benefit each other and reduces the risk, right?
Yeah, so it's usually bonds and stocks.
Correct.
But unfortunately, with the zero interest rate environment, the bond part suffered pretty badly. Suffered. It didn't make up inflation since 2010, essentially. So this is one of these things where it's the same. It's the same old school thing, but just done in a modern way. Yes. But we will get into it in a little bit later. I think this slide's a little bit ahead of where we needed to be. But so we essentially just went and asked the clients, well, they're sick of this. I think it was Grain Corp was one of the income stocks that we had, and it was plummeting, and it's since come back. But everyone was a little bit stressed out, and they just wanted less stress generally. So we went and tried to find other solutions to maybe fill the gaps in the portfolios, so we didn't have to choose a stock because it had a dividend yield, and where we were making compromises. But also
it comes back to the fact where, if you deployed all your portfolio, let's just say, for example, you had $500,000 to invest. If you had such a large allocation to one of these stocks and goes down 10%, your portfolio is swinging around by, a couple percent every day. And it forces you to make really bad decisions, because you look at the screen and you look at your P&L, you go, wow, this is drawn down this, or it's gone up this, or whatever. It forces you into bad decisions.
And let's face it, everyone based on the phone calls that come in here, everyone checks their portfolio way more when the market's getting hammered than when it's going up.
Even seasoned pros,
I know, absolutely.
Everyone looks at the P&L.
Look, we all make the same mistakes. We're not above this stuff. Where almost like the market's a bit of a therapist, you workshop through it. But so basically, in that scenario, we're like, well, what do you want? But they didn't want grain corp. They just wanted the income. Hybrids are being decommissioned and things like that. And then we had a look at the structured investment space. And basically, we found a product called fixed coupon notes, which essentially is still backed by stocks. And we construct it, and you don't necessarily need a degree in actuarial studies like yourself, or be an options trader, but we make these things ourselves here. We formulate them all ourselves with our own risk profiles, etc., to generate that yield. So it's same but different. If those of you who watched Ausbiz with the call, every time I get asked about the big four banks now, we put the big four banks into a basket, and then we derive a yield out of they're selling options, etc. And we average around about 11% or thereabouts. So the banks themselves only in the last 10 years have only made 8%, including dividends and franking, as if you bought all four. So we're using the same asset to derive a higher income without the stress, which has been probably our most popular product. So yeah, we're basically they're around about. We tend to do a basket of them, and we will diversify them. We don't just do the banks one; we'll do other ones as well. But because there is an element of risk in these, in terms of if they breach a barrier, whole separate video. But long story short, we can when done in the correct manner, you will average nearly 10%, just about. Even with a downside. Factored in to the.
I think to put it really simply, it's a comparable to dividend stocks, right?
Well, it's actually in equity index.
Yeah,
like
for returns, I think it's we're getting an extra 3 to 4%, but in terms of risk profile, really, it's quite similar to holding a dividend basket.
Yeah, well, very very similar to hybrids. It has very similar characteristics, and that's where we came to that conclusion. But then. We could then remove the dividend stocks we didn't want, and we put them, we plonked them in this, and that solved the problem. And then we've essentially now, there's a whole thing on private, like a document on private credit and against hybrids. Again, we won't go too far into it, but there's a whole background to it. And then essentially then we also looked into growth strategies. So we started with the gold and silver strategy. And that was our first one in 2024. And essentially it was you were long both gold and silver, which all of our clients wanted to buy anyway. So for instance, they would have invested 100 grand in gold and silver, which they would have had to pony up $100,000. So this was a thing where we did it via what's called an enhanced growth strategy, and it was only $10,000 down. To get that $100,000 exposure. They're buying call options, which means that with your first $10,000, that pays for your strategy, that pays for your leverage, that pays for your protection to the downside, etc. And that's all. That 10 grand's all you can lose.
Right.
But you're getting that 100 grand, and the clients were a little bit nervous. They didn't understand, but 12 months later. Gold and silver, as we know, rallied, and then we had, I think for every $10,000 a client put in, they received back $41,500. So, which was 41% on the notional amount, but obviously 313 odd percent on their capital. But the big thing was, then they had 90 grand spare, so they could invest in, or they could go and buy a gold miner, they could go and put it in the bank, they could buy fixed coupons or whatever. But the capital efficient nature of it was a great solution because you've got that extra cash to deploy.
Yeah, exactly right. So I think that's the two greatest benefits: capital efficiency and also the automatic risk off. Because I think the way to think about these enhanced growth products is basically, if I was going to put $50,000 inside a gold, let's just say a gold ETF, I wanted to buy $50,000 of gold ETF. Why would I put $50,000 of cash in there? I could use $5,000 and represent the same investment, right? But the good thing is, if gold goes down 30%, there's an automatic stop built into it. So basically, you lose that $5,000 that you've put in, and that's it.
And what people, and these all, they change per strategy, but essentially what the clients really liked about it was, I know how much I can lose and I'm not missing out on the upside. And that's really, at the end of the day, all they cared about. You can go into the weeds and work out how to, how it all gets constructed, etc. But that's up to you. But that capital efficiency was a major advantage, essentially. And what it sort of enabled us to do, was we looked at then doing index investments. Currently we've got buy the dip, which is an S&P 500 index investment over 3 years. We built in a feature whereby it's got a 6-month, what's called lookback. So we all think the market's too high at the moment. That's probably why everyone's here at the webinar. So we're getting people to sell their S&P ETFs, and then they invest in this, but they re-enter the S&P index at the lowest Monday closing price for the next 6 months.
Yeah, can you just explain a little bit more about how that actually works over the 6 months? Because a lot of clients call in, they go, "How is that possible?"
Well, with this feature, we essentially set terms with the counterparty, which is Citigroup, and then it's every Monday closing or settlement price. And the lowest settlement price in that will be your entry. So
correct.
First 6 months, the observation period. In terms of how they do it, they're in with daily options and things like that. That's more of a JT question. But essentially, what it does is it removes your worry about about timing the buy. Add to that, it's 6.5 times leverage to the upside. So, but what it does is basically you can set a plan. We construct the strategy, and then that's it. See you in 3 years, and you don't miss out on any of the upside there. And this actually works better. Well, we back tested it to the tech bubble. So the tech bubble, if you put 100 grand into an ETF, you're down 51,000. This, for the same notional or the same upside exposure, you're down 15,000 or 15 to 17,000. So again, it's what the investors really like is, I know if the market craps the bed, I know how much I can lose. If the market goes up, I'm going to get I'm going to get the same return as an S&P ETF, and I got 85k or 84k left over.
That's it. That's the brilliance of it. Like, upfront how this thing can. You don't know the end result in terms of what the returns will produce, but you know what worst case you have, and also how it will work if it does outperform.
Yeah. So again, going back to that client desire, they want to sleep at night, and they want more returns and less risk. So this has been a 3-year journey for us. And look, and we obviously, and going back to that modern 60-40 thing. So if you can, if you're spending 15 grand, you've got 84k left over, then obviously you could maybe put most, I say 80k into fixed coupon notes, which is it's not technically a 60-40, but it's pretty close.
The idea behind it is basically, you have, from your fixed income side, you have cash flow that's coming in. Basically, what we're trying to do is how much of that income are you willing to sacrifice to grow? But when the whole point of separating these two baskets is that we can do each one of these baskets very well.
Yeah.
Right.
They're optimized.
That's right. We're getting higher yield in the fixed coupon basket, and in the growth one, we want to grow. We want to use our capital very effectively, and we want to buy a growing asset. And that's
and then, as in terms of your entire portfolio, we're not saying don't trade stocks anymore.
No.
So our philosophy is now turned to, now we're making far better decisions in our high conviction part. So our actual stock portfolios now are not we're not trying to be diverse. We're not trying necessarily to be, look for income, but we're looking for great companies at great prices.
That's it.
And so, but the rest of it is via using these methods, The rest of it's taken care of. It's stress-free. It is what it is. You've reduced your risk. You
Basically,
capture the gains.
It's basically what the superannuation funds are doing, but we can do it better.
Yeah.
Right. So,
But then you're going back to what we found is everyone then makes much better decision makers
that's right.
in their high conviction. So we still manage stock portfolios, but we're not trying to juggle 30 balls all at once and deal with risk. We're removing 15 of those balls and going, right, set and forget, see you in 3 years. You can't get worse. You'll outperform the index, although, in every scenario, essentially. And then the rest of it, okay, let's concentrate on the companies you want to own. Again, like that, the sort of that value style, that Buffett style thing. So, but it's a lot easier to be patient, and when you know you're not missing out.
Clarity is the key, and I think this came a lot through with a lot of conversations with the clients, right? Because you do have a lot of different styles of investors in this space. You have short-term investors, long-term investors. The biggest problem you will run into is when you have the wrong rules for the thing you're trying to do.
Yeah.
So I think basically the bigger picture of overall what we're trying to do, we want to have clarity. Each single product and each way we're doing things, we want to know exactly how we want to.
Yeah, they've got a job and they've got a set of rules around that job. And like I say, and if you're optimizing out your income, you're optimizing out your index, which we've all got index ETFs and income investments, etc. But you want, take that, and then with the rest of your portfolio, you're not making in your individual stocks, you're not making compromised decisions and taking on positions that you're taking on that only meet, say, 2 of your 5 categories of your investment selection. So we will send this the slideshow along as well. It's got some stats on how quick the market bounces these days. What the average rebounds are. These statistics, because of the algorithmic trading, actually hold true better than ever before, to be honest. But average days from a breakdown to down 20% or a bear market, back to break even is only 127 days now. Used to be 600 days.
Yeah, wow.
So that's pre-2015.
Yeah, I guess this is what we're feeling. This is why we're feeling that the market's so quick.
It's so fast. And so, I mean, that's, if you want to be really crude, it's 5 times faster.
Yeah.
But it does tend to rebound out. I mean, indexes are designed to go up. They remove the bad stocks and they put in the new ones.
Exactly. And I think that's the little secret that people kind of glance over, right? So S&P 500, it's the top 500 stocks. It's always the top 500 stocks. The bad stocks get removed. The good stocks get placed in, the growers. So naturally over time, that's why it actually grows.
Yeah. So, I mean, this is this is sort of the slide where we're saying the income engine, the growth engine, and then your high conviction equities. But the big one here is the defined risk mindset. So that's where people are sort of getting on board this philosophy with us more so, is that having those defined rules, defined risk things, and they make better decisions. There's less stress, and normally they're making a bit more money. So overall, I mean, look, we do have a portfolio review software here called Prism. Everyone who's joined, we did about 15 at the last webinar, which went over really well. Thankfully, I don't have to do it by hand anymore. So by all means, anyone who's watching, you feel free to send it in, and we can run through it with you. We do have one of the index investments at the moment with Buy the Dip available. And also, we didn't have a Q&A this time because obviously, I think there'd be some pretty specific questions, particularly that's why we brought up Cochlear and CSL. But please email them in so we can give them the justice that they need. Or do a portfolio review and things as well. Or if you've got any sort of inquiries as to things like the risk management plans we've done for people in the past for large positions. That's a service that I believe no one else does in the Australian market. Fixed coupon notes and things. So, But yeah, if you've got any interest in that, but in terms of we'll send a little bit of a package along in PDFs that further explains, because I know that we can fit every kind of strategy in every in 40 minutes, and we've already taken up 40 minutes. But look, we've come to this over a 3-year journey ourselves, essentially. Probably guys have also done the maths than I have. But we bring that experience where it's just don't accept the norm. Don't accept the you don't need to don't need to ride a push bike when you can drive a car, it's really one of those things where there are new products available out there. They've been around everywhere in the world. They're highly popular in the US, structured investments and things. Private credit's another one as well. We've got a little cheat sheet on that. But yeah, it's not the old portfolio, balanced portfolio or model portfolio it's dying, basically, or it's a thing of the past. We've just given our backgrounds, we've just adapted. So if you want any more information, obviously go to the website. There's some information on the fixed coupons, or the modern 60/40, the growth investments, etc. Portfolio reviews on the homepage, and then and we obviously have a chat around. You can choose Kai if you'd like to have Kai do your portfolio review, or Jonathan, or myself, or if you don't care, whatever. And we'll sort of assist you get to your end goals, I suppose.
And that's really the key of that strategy, right? Basically, it's giving the client, it's giving the investors the ability to control their outcome.
Yeah.
Right. The secret is in the allocation, because if you want more growth, you can allocate a bit more to growth. If you want a bit more income, we focus on the same.
And what that ASX market at the moment, it's just a lack of control. Investors they're so frustrated, and I feel for them. And and I don't mean to be a smartass when I go well, we're doing this now, but we were frustrated too. We just adapted. We didn't try to fit a square peg in a round hole. We just went and found the square hole, and we get on with the job. So markets are ever changing. No one strategy works forever. So yeah, if you want a hand, that's what we're here for. Kai, thank you very much, and thank you all for joining us. You can submit any Q&As on the website, or via the contact us, or check out many of the things, and we'll send you a little package in the next couple of hours with the on-demand video and a PDF. Thanks for joining us, and we will probably see you again next month.
Thank you.